All right, welcome to video number 7 in the series. This is the second part of my position sizing series. We got a series within a series. In the last video, I talked about why you'd want to size your position based on risk and the benefits of that. Now I'm going to talk about why position sizing can actually have a big effect on your money management. In a previous video, this one back here, we talked about risk reward and win percentage and how you can use that to sort of calculate if the system works, how much you can expect to make from a system, right? And how those two things, if you have those numbers in order, you can kind of guarantee that you're going to be making money. It's not completely true. There is a third aspect, and that is your position size. You can have good win percentage, good risk reward, and still lose money or make money. That can actually change depending on your position size. So I'm going to use a couple of examples to illustrate that point. First, let's talk about using a fixed position size, right? Or a fixed dollar, meaning you're always using the same amount. So let's say you have a $1,000 account and you want to trade with 10% of that account. A lot of exchanges will just have a button that says like 10%, 20%, 50%, like to just use 50% of your holdings for this trade. So if you're a person who likes to press that 10% button, that means you're trading with $100 every trade, right? And let's say we're going to do 2 trades and they're all going to be 1 to 2 risk reward. And you're going to get a 50% win rate, right? So we're just pre-establishing that. So let's go through the 2 trades. So the first one, for whatever reason, you buy here, whatever your signal tells you, and it tells you, based on a support or whatever, that you should put a stop loss here. And that happens to be a 10% drop. So if you have a 1 to 2 risk reward, that means you'd put your take profit up here. It's a 20% gain, right? Let's say trade number 2, similar setup. Maybe it's just, less volatile this day. And so you're going for that same stop loss, but this time that drop is only 5%. And that would mean if you have a 1 to 2 risk reward, your take profit is going to be 10% above the price, right? So it could be the same signals for the same reason. This is just, the price is just moving a lot more this day and a little less this day. So let's play it out and pretend that you lost this first trade and you won this second trade, right? So over here, if you bet $100 and you lost, you would have lost 10% of $100, meaning you lost $10, right? Over here, you would have won, and on this trade, a win would equal 10%, so 10% of $100 means you won $10. So you come out to a grand total of $0, right? You won 10, lost 10, come out break even. So now let's just real quick try that with a relative position size. So let's say you have the same $1,000 account, but you choose to risk the same amount every trade, and let's say you choose 1% of your account. So that means you're risking $10 per trade, right? The first thing you would do is calculate the position sizing for both of these, right? Kind of like we did in the last video over here. What we would do is say, okay, we want to risk $10. On this trade, the most we could lose is 10%, or the most that price can go against us is 10%, and the formula for that was you do 10 divided by 10%, which is pretty easy math to do, but just to make sure. So you would have a $100 position size here. On this trade here, because there's a 5% drop to your stop loss, and you want to risk $10, you do the same math, divided by 5% equals $200. So on this trade, your position size would be 200, on here it would be 100, and as we saw in the previous video, both of them are going to lead to a $10 loss, right? So let's play this out now with these 2 examples. Here you positioned $100 and you lost 10% of $100. That means you lost $10. On this trade you won, but your position size was $200, so you won 10%. 10% on 200 equals $20, right? So you lost 10, but you won 20. That means you made $10, right? So the first thing you might say is, well, okay, this one made money, that one lost money, so therefore this is better than that, right? That's kind of like the obvious implication. But let's try something else now. Let's flip this. Let's say you won this first trade and you lost the second trade, right? Still 50% win rate, but we're just kind of flipping the order of which ones you lost, which one you won, because you don't know which trades you're going to win, which trades you're going to lose, obviously. So in this case, your $100 position size over here, you would have won this trade, which had a 20% take profit. So 20% of $100 is $20, right? So you won $20. Over here, you lost this trade, which means you lost 5% on your position, which is 5% of $100 is $5, right? So you won 20, lost 5. That comes out to $15. Let's do it over here now. $100 position, you won 20%. 20% of $100 is $20. Over here you lost 5%, but you lost 5% of $200, which is $10. In case you don't believe me, 200 times 5% is $10. And so that means you made a total of $10. So a couple things you might notice there. Now you made more money here than you did down here, right? But the other thing you may notice is that both times I made $10, regardless of which trade I won. So what you sacrifice to make more money here is the consistency. You sacrifice always having the same results regardless of the percentage changes. And what I really like about that and what that illustrates is that you had a 1 to 2 risk reward and a 50% win percentage. And if you kept your position size the same, no matter what happened, you always made the same amount of money, right? Every time you lose a trade, you lose $10, right? When you lost this trade, you lost $10. When you lost this trade, you lost $10. And when you won this trade, you won $20. And when you won this trade, you won $20. Because when you establish your risk beforehand, we said here that you have a $1,000 account and you're risking 1%, which means you're risking $10. But if you have a 1 to 2, that means you also know that every time you win, you're going to win $20. Like no matter what happens, every loss is going to be $10. Every win is going to be $20. Why I really like how this plays out is that all you have to worry about at the end is your win percentage, right? So if you have a 1 to 2 risk reward, that means you have to have a 33.3% win percentage just to break even. If you do 3 trades, that means you lost 1 and you won 1 and lost 2. And if when you win 20, that means you won 20, and when you lose 10. That means you lost 2 trades for 10. That's 20. That's break even, right? 33% is the break even win percentage for a 1 to 2 risk reward ratio. So if you're keeping your position sizes the same, your goal as a trader is just keep my win percentage above 33.3%. It's that simple. Keep my win percentage above that amount, right? It goes back to this concept from the very first video, how it can be extremely simple, right? You don't need to worry about making money, how much you're going to make, all of the stuff that comes with trading, all of the ins and outs. You have one goal: keep my win percentage above 33.3%. If you have a 1-to-1 risk reward, you have to keep your win percentage above 50%. This only works if you have position sizing that is consistent. Because if not, like we just showed, your results can vary. So if you tell yourself, I just need to keep my win percentage above 50%, I mean, what is easier than that? Just win more trades than you lose. That's your only goal. And I think that gives you a lot of confidence because you feel like you can whittle down your goal to such a simple concept that you don't feel that overwhelmed because it kind of doesn't matter what else is going on. I just got to get my 50% and I'm good. So I want to illustrate this just because I kind of cherry picked these numbers a little bit. Like I chose 1% because I knew it would be $10 and I wanted it all to kind of make sense. Just to give you a slightly more complicated example, let's say you're going to do 4 trades right? And you're going to use these same kind of account sizes. Let's say you have a chart that goes like this, and you put your stop loss down here, and your take profit up here, and that's a 3% drop, and it's a 6% gain, right? Because you're doing 1 to 2 risk reward. And you do that 3 times in a row because the market moves about the same, and it's always exactly the same. And you win 3 trades in a row. So the first one you won 6%, second one you won 6%, third one you won 6%. And then on a more busy day, there's a lot more volatility. Same chart, same setup, everything you trade for the exact same reasons. Your signal tells you to put your stop loss 20% below the price, which would mean your take profit is 40%. And normally you might be like, wow, there's a much bigger swing. But if your position sizing is exactly the same, these numbers shouldn't matter to you. And let's say you lose this trade. So you lose a 20% trade, right? Because you don't know which ones you're going to win, but you want to take it because your signal is saying this is a good trade, but it's telling me I got to put my stop loss down here. So let's play this out with this position sizing, $100 position every time, right? Here you would lose $6, or sorry, you would win $6. Here you would win $6. Here you would win $6, and here you would lose $20, right? So that comes out to $18 minus 20. You lost $2. Let's do the opposite. So just to position size it really quick, you're trying to risk $10 per trade, right? And this is a 3% drop, so 10 divided by 3%. It means your position size would be $333, right? And $333 on a 6% gain is 19.99, essentially 20, right? We established that every time we win, we're winning $20. So here you win 20, here you win 20, here you win 20. Okay, and now your position size would change for this one. Again, you're trying to risk $10, but you got a 20% drop. So your position size is only $50. Notice how much smaller the position size is. The other one was 333. This one's only 50 because it's such a big drop difference. So you trade $50 and it drops down 20%. So 20% of $50 is $10. Like we said, we're always going to lose $10. We're always going to win $20. So over here, you lost $10. So what does that come out to? 20 plus 20 plus 20 is 60, minus 10 is 50. So that is a very drastic difference, different results, right? Both of these systems had 75% win rate, and both of them used 1 to 2 risk reward. But this one lost money, and this one made substantially more. So what that tells you is these numbers don't tell you if you're going to make money or not, okay? You need to have the position size in order. It's the combination of all 3 of these things that can predict if a system's going to make money or not. When I started position sizing the way I'm talking about here, and again, you don't have to do this. You can position size like this and make a lot of money, and cool, good for you. I'm not trying to tell you how to do it. I'm just saying this is what worked for me, not only because the math kind of made a lot more sense, but that psychological thing I was telling you about where like my only goal is to keep my win percentages at a certain point, you know? That's it. It kind of, like everything in life, if you set your goals, if your goals are too big and too abstract, they're really hard to achieve and kind of wrap your head around. Whereas if you just set small goals for yourself, it becomes much easier to kind of aim for those goals because you don't have to worry about anything else. You don't get distracted by it. You don't get overwhelmed by it. You don't get anxious about it. So that's why I think all of this position sizing stuff from the last 2 videos is huge if you can start doing that. I will close out with a couple notes about position sizing. One is I have seen, professional traders who will vary the amount of risk they trade. Like instead of 1%, they might risk 2 or 3 on certain trades. And the reason they'll do that is if they're getting a really strong signal, like all of their signals are all lined up and saying to buy, they might go for a bigger risk. Usually they're doing that because they have the data to prove it. They have the data that says, when all these signals line up, I am X% more likely to be right than wrong. So I wouldn't recommend doing that unless you have that data to back it up. You shouldn't just say, I really feel strongly about this one, so I'm going to risk 2% or 3%. Like, you should only do that if, you got the math there. The other thing is when you're, when I'm testing out, like a system and I want to use actual money just to kind of like put some skin in the game, I might, throw in like a couple bucks, right? I'm throwing $5 per trade or something just because I'm only going to lose like a few cents. You don't want to have to be calculating your position size all the time. I mean, maybe it's not that complicated, but you can still get a win percentage and a risk reward, like so a 60% win percentage and a 1-to-1 risk reward, and still determine that that would make money if you did proper position sizing, right? So you could trade $5 every single time just because you want to do it quickly and you want to test. And like we showed here, it won't necessarily mean you're going to make money or lose money. It won't show you the actual profitability because you're not sizing it right. But you can extrapolate, look, in the future, if I did position size correctly, this would make money, right? So you can just have this number and this number and determine whether or not the system makes money or not. If this is a 40% win percentage, I can tell you it's not going to make money, right? Because you have to win more than 50% with a 1-to-1 risk-reward ratio. So you can kind of extrapolate if a system works or not without the position sizing, but when you're actually doing the trading, that's when you have to do the position sizing to make sure that you're guaranteeing your success. All right, so that's the end of the position sizing series. I'm pretty sure all the videos after this one are all about improving your system. So if you can get your system to this point where you get these numbers in order, you're pretty much set, because like we were explaining in that last video, it becomes mathematically impossible to not make money if these numbers are in order. Again, easier said than done, but if you can kind of just worry about that, we talked about simplifying everything as much as possible. If you just worry about these three numbers, at that point, you're golden. So I'll see you at the next video, and leave me any comments or questions.